Hello everyone. In the previous video, we talked about leverage, and I gave you an example. Like, if let's say you have $10,000 in your account and you are trading gold, and let's say the price of gold at the moment you want to enter a position is $3,300. If you are in real world, your money is enough to buy 3 ounces of gold, almost 3 ounces, which is equal to 3 microlots, 0.03 lots. Uh, you might decide that this is a good price to buy, and instead of buying 3 microlots, you buy 10 microlots at the price of 3,300, and you want to take your profit at 3,400. In this scenario, if your plan works, you are going to make, for every dollar that the price of gold goes up, you are going to make $10. And in this case, you are going to make 10 times 100, which is $1,000. And in case the market moves against you, you enter at this price, and then the price of gold falls to 3,000, for example. This time you're going to lose 10 times 300, which is $3,000. And in case uh, the price of gold falls another $700, you are going to lose all your money. So you lose all your money because you are using leverage. That was the example. Now you might say, I'm not going to buy 10 microlots. I'm going to stick to this 3 microlots. What must happen for you to lose all your money? Certainly, the gold price might fall to zero if you buy 3 microlots at the price of 3,300. The broker will calculate like this. You buy 3 ounces at the price of 3,300, but you pay only 1% of this value because you are using a leverage of 1 to 10, 1 to 100. So you pay only 1%. It means you pay only $99. And then your free margin will be this $99 minus this $10,000 that you have in your account, and you still have a margin of $9,900. You will lose all this amount only if this amount falls to zero. It means gold loses all its value, 3,300 minus 3,300, it becomes zero. So let's say gold loses all its value times your 3 ounces, 9,900, and then you'll be zero. This is very unlikely. Gold is not going to lose all its value. So as long as you stick to the actually you don't use leverage, you will not lose money. Only you lose money if the price of gold goes again, like it will happen in the real world. So you might say, okay, what you are going to do, you say, instead of buying instead of using leverage. Actually, you use leverage because you don't pay all your money to buy gold. You pay only 1% of the value, and then you have the free margin. Looks very good. So you say, all right, I buy at this price, 3 microlots, and I wait for the price to go to 3,400, and I make $100 times 3, and I make 300. Very good. So you start at this price, and then you go out of the market at this price. From here to here, you make 300. Then again, the price seems to be going up. Again, you buy another $100, and then again, you make another 300, and then the price again goes up. You decide again you must buy, and again here, you make another 300. Everything is fine, and then you buy again here, hoping the price will go here, but actually it falls here. It might happen. So let's say here was 3,600. You bought, and the next day or the next 2 days or the next week, you see the price is 3,000. What about this case? You will see that gold has lost $600 of its value. So for every dollar you are losing $3 because your lot size is 3 ounces. So now you are minus 1,800. You're still alive. You have 9,900 in the free margin. 1,800 is floating, and you still have 7,100. But then you decide it's a good price to buy. Again, this time maybe you buy 5 microlots. Again, it falls. It goes down again. You buy again, and suddenly you see your account is minus 7,000, minus 8,000, and you will start to panic because it seems you're going to lose all your money. Therefore, what most traders do, the professional traders, what they do is they use a mechanism to prevent losing all their money. That mechanism is called stop loss. What is the normal behavior of a retail trader in the market? They wait for the prices to go down. They look maybe for a pattern like this. The price falls, and then they wait for a buy signal here. We are not discussing the buy signals, just giving as an example. They buy at this price, whatever price is this. Let's say it's again 3,300. And they put stop loss below here. Let's say it's 3,250. From here to here is $50. And so this is your stop loss. It means if the prices go below 3,250, you want to lose money and go out and wait for the next opportunity. And they want a risk to reward of 1 to 3. It means if they are risking $50 here, they want to catch $150 movement upward. This is called risk to reward of 1 to 3. Now, a professional trader would say, I'm going to risk 1%. Some people say 2%, 3%, half of a percent. Let's say 1%. I want to risk 1% of my money here. And If I lose only 1%. And if I win, I want to win 3%. Okay. Again, let's say you have $10,000. You are risking $50 movement, and 1% of your money is 100. So you buy two microlots at this price. In this scenario, if the price, let's say you buy here and the price goes below here, you lose $100 because you bought two microlots and the market moves $50 against you. So you lose $100 only. You still have 9,900 in your account. And if the market goes here, you make $300. Now, looks like a wise plan. And again, you want to be on the right side. You want to make right decision because these are all probabilities. You want to be right at least 60% of times. Means if you understand the market correctly, if you make right decision, you cannot be 100% of times right. 60% is already very good. If you are 50% of times right, you're still good. I will explain why. So here, this win rate, the higher the better. Well, let's say your win rate is 60%. What is going to happen is in 1 month, in one chart, I think you can open maximum 10 deals. If you do more than 10 deals on one chart, more than 15 deals on one chart, you are over trading. You are opening haphazard positions. Let's say you open 10 deals in 1 month on one chart, and from these 10 deals, 6 are right and 4 are wrong. 6 times you make 6 times 3%, 18%. And here you lose 4%, and end of the month you have made 14%. 14% of your capital, $1,400. Maybe you say it's not enough, but proportionate to your capital, you have made good money. You trade other charts with the same rules, maybe 3 charts. Okay, if you cannot expect 100% profit every month, it's impossible. If you target this, you lose all your money. If you manage to make 30% per month, you are among the best traders in the world. This is already very good. 14%, 20%, 10%, 15%. If you manage to make it 30%, you are already among the best traders in the world. This is the whole collective behavior of professional traders. So, stop loss, take profit, wise using of leverage. This is just a simple example of how you must behave as a retail trader with a very limited capital in this market and what you should expect. Now, we have in this market the retail traders. It means people with less than $1 million in their accounts, and we have the big boys, the banks, the hedge funds, the anybody with more than one, the big boys, the market makers. How do they behave in this market? I will talk about this for maybe a couple of minutes, and this will be the topic of the next video. All right. So we are retail traders. Retail traders are people who have less than 1 million and they put stop loss and take profit. We are retail traders. We retail traders buying 2 micro lots, 5 micro lots, 1 lot, 3 lots, 10 lots. We cannot move the market. Who is moving the market is the banks and the big boys. The purpose in their market is, let's say, in a situation that it was in my example like this. They want to create a situation in which most of the retail traders are convinced that this is the right time to buy. Millions of people, hundreds of thousands of retail traders, they enter long positions. Long positions means orders, it means buying positions. They enter positions here, they put stop loss here, and then these banks will want to move the price here and then here, just below your stop loss. This is how they make money. These banks, the brokers, whoever gives you leverage, they give you leverage because they want you to come into the market, buy, put stop loss. They want you to sell at this point, put stop loss, they push the market here, collect your stop loss, and again go down. So this is the game we play, this is the game they play. And if you want to consistently make money in the market, your job will be to find the right entry point, where to put your stop loss, where to take your profit, and this is how you make money. These people want to collect your stop loss, and the market will not go here before collecting enough stop loss. That is the purpose of this market. We, the retail traders in the market, are the cannon fodders. We are food for them. We don't want to be food. How not to be food for these people? We are going to discuss in the next video. We have to put stop loss, but we must put in a very wise way with a very calculated risk and get minimum 60% of risk to reward. Thank you very much.